if you spend any time at all on business news media, our next speaker is no stranger to you. You've probably seen her many times. Stephanie Link is the Chief Investment Strategist and Portfolio Manager at Hightower, our strategic partner and one of the nation's leaders in offering financial solutions to individuals, foundations, family offices. As an investment professional with 29 years of experience in managing money, her insights are frequently sought after, as I mentioned, on national news media. She is currently a CNBC contributor and frequently appears on the Halftime Report, Squawk Box, Closing Bell, and Power Lunch. I mean, pretty much daily you can see Stephanie on, she was probably on CNBC, but it's this morning before she came here. Prior to joining Hightower, Stephanie was a senior managing director and head of global equities research at Nuveen, where she co-managed the CREF stock variable annuity portfolio with $170 billion in assets, managed her own U.S. core portfolio with $3.7 billion in assets, and oversaw 33 investment professionals who collectively managed $40 billion. Stephanie's got game, let's just say that. She also, prior to joining Nuveen, she spent 7 years at the Street as Chief Investment Officer and co-portfolio manager of Jim Cramer's Charitable Trust, and also served 10 years at the Prudential Equity Group as Managing Director of Institutional Sales. Please join me in welcoming Stephanie Link.
Well, I'm delighted to be here. I've never been to Wichita, so this has been a great experience so far, and a great crowd. I wanted to poll the audience before I start with my presentation. Just to ask a couple of questions. How many of you think that we are headed into a recession this year? How many of you think that we can avoid a recession and see a soft landing? A soft landing is just slow growth. And how many of you think that the international economies are going to grow faster than the US this year? Oh, that's great. Okay, well, we'll get to all of that, but I always like to see how the audience is feeling at the time, at the beginning. Maybe at the end you'll feel a little bit differently. I don't know, we'll see. I think that I'm going to start with the US and the economy, and I'll get into some themes as well in terms of investing, but I think this is one of the hardest years I've had in my career in terms of assessing the economy. There are so many puts and takes that are happening this year. So on the negative side, we have manufacturing, which has pretty much been in a recession for the last 6 months. If you look at kind of the surveys, the PMIs and ISMs and regional manufacturing series, they're very much below 50, which these are diffusion indexes. And so they've been in the mid-40s for over 6 months. We've seen a slowdown in housing. Last year, housing starts were down 17%, and permits, which is a leading indicator, were down 25%. And of course, we have some issues with the banks, I'm sure you've heard, and as a result, we're seeing tighter lending standards. So that's the negative side. And of course, we do have the debt ceiling issue. But that's the negative side. On the positive side, and it's a really big one, it's the consumer. The consumer has been resilient. And why do we care about the consumer? Because it's 70% of the US economy. And why is the consumer resilient? Because the job market has been incredibly tight. Any measure you look at in terms of jobs, and I look at them all. The non-farm payroll numbers, the ADP numbers, those come out monthly. Initial claims, that's more of a leading indicator, they come out weekly. And then I look at JOLTS, which is job openings. And there are 1.67 jobs available right now for every one unemployed person. Now that number last year was running about 2 to 1 ratio, so it's come down. And some of the numbers in the jobs, like if you look at the initial claims, they are starting to go in the wrong direction, but it's still a very tight market. And wages, as a result, are also much higher than average. By a lot of different metrics that I look at, average hourly earnings are running up 4.4% year over year. ADP comes out with a report as well, and they show 7% growth in wages year over year. And if you switch a job, you can get 14% growth in wages, which is really remarkable. Unit labor costs, that's another way of looking at the wage component. That's running up 6.3% year over year. So you get my point. There are jobs to be had. If you want a job, you can get one, and you're getting paid more. Yes, there is inflation, and we'll get to that as well. But it's a very healthy environment, and consumers, especially the US consumers, we just love to spend, whether we take on debt or not. But guess what? They don't have to take on that much debt. They have $2 trillion in savings still. So in the GDP number that came out for the first quarter, it showed that real final sales were running up 7.7%. And that's really remarkable, too. And a lot of it is driven by services, because we were all cooped up at home for 3 years, right? And so now everyone wants to go out and about. So they're buying less goods, because how many laptops do you need, right? How many times are you going to redo your office, your home office? No, right? So there's less goods buying, and there's more services buying. Restaurants, hotels, airports, airlines, etc. And that's really a good thing, because services is 75% of consumption. So that's the real positive side of the economy, and we root really hard for the consumer. Now, I mentioned inflation. Inflation is a problem. It's definitely peaked. We got the CPI numbers this week, and it definitely showed a slowing. So in June of 22, the CPI inflation index was up 9.1% year over year. We got a number yesterday that showed 4.9% year over year. So we're making progress. The problem is the Fed wants that to be 2%. And that's their goal, right? They have a dual mandate looking at jobs. That's good, because we have 3.5% unemployment. Haven't been that low since 1969, by the way. And so that's the one measure that they look at. The other is inflation. They have to make sure that inflation is under control. Price stability is what it's called. And we don't have it. They're trying to slow us down pretty quickly. We have seen interest rates rise to levels we haven't seen since the 70s and 80s. We went from a 0% Fed funds rate to 5% in a year's time, because the Fed was behind the curve in addressing inflation, saying it was transitory when it really wasn't transitory. Or maybe it was just more stubborn. So so the good news is that we're probably in about the 8th or the 9th inning of the Fed raising interest rates, because they've done a lot. And I don't care if they go another 25 basis points or not in June. It doesn't matter. They've already raised rates so dramatically. And there's a lag impact of that, right? So it's about a 12-month lag from the time the Fed starts to change monetary policy, whether they're raising policy or they're cutting rates, raising rates or cutting rates. So the bottom line here is that the Fed hopefully is going to just pause. I don't think they're going to pivot. I think there are a lot of people out there that think that they're going to cut sometime this year. I just don't see it. But again, the good news is at least we're in the 8th or 9th inning of them actually raising interest rates. So the impact overall is going to be the economy slows, and is it a hard landing or a soft landing? And there are some of you that think that it's going to be a hard landing, and some that think it's a soft landing. I don't think we should be afraid about it. I mean, like, everybody is talking about a recession. It's kind of depressing. So we'll get through it, and we'll see what the Fed does, and we'll have to watch the data. And the data so far has been, as I said, pretty mixed. But the biggest piece of the economy is the consumer is doing well. And we just had companies report earnings. And I always like when companies report earnings, because I get a chance to listen to what they have to say, companies, on the front line. And we didn't hear gloom and doom. Really, at the end of the day, we actually heard JP Morgan and Morgan Stanley and Goldman Sachs say that they actually saw strength from the consumer. Wells Fargo grew loans at 6%. Coca-Cola had organic growth of 12%. Mondelez had organic growth of 17%. That doesn't sound recessionary to me. And in fact, if you look at earnings overall, about 85% of the companies have reported earnings. And again, I like to, it's very short term in nature, but I like just to hear what management teams have to say. And earnings actually, so 85% have reported in companies in the S&P 500, and 76% of them beat expectations. Okay, expectations had been lowered, I'll give you that, but they didn't say that demand fell off a cliff. I just gave you some examples. I could give you a whole list of other examples too. Demand has held in, margins have held in, supply chains are getting better, and inflation is coming down. That doesn't sound bad to me. And so as a result, earnings have held in better than expected. And you have some people, and they're colleagues of mine on TV, and very smart people think that we're going to see a massive recession in earnings. We haven't seen it yet. Certainly if the economy slows, earnings are going to slow, but I give US corporations a lot of credit because they'll see it, they already are seeing it. We're seeing some layoffs, you'll see restructurings, and hopefully they'll still have some form of pricing power. They've had an enormous pricing power in the last 2 years just due to inflation. But the point being is that earnings and companies will adjust and adapt, and there are a lot of opportunities out there. The issue with the market and why it's kind of gone sideways this year, in my opinion, is because there is an alternative. There are a couple of alternatives, right? I mean, you can get 4 or 5% on a T-bill or a short-term bond and call it a day. You don't have to worry about earnings and recession and everything else if you hold it to maturity. That hasn't been the case for the last 10 years because of the zero interest rate policy that the Fed undertook. But now you can get real money in fixed income and you don't have to worry about equities. But I will say this, the long-term average in the S&P 500 total return is 7%. That's not so bad. But you just got to ride out the volatility, right? I mean, last year was not pretty, down 18%, but the year before that wasn't normal either. We were up 28%. So somewhere in the middle, you have to average smooth it out, and you still should own equities. Of course, I am biased because I run an equity portfolio, but I do think that the alternative is one of the reasons why the markets have actually gone sideways this year, right? And in addition to that, the international markets have actually done quite well. Europe is up 12%. Japan is up 12% this year. And we'll get into that in a bit, but there are a lot of places to put your money versus just being in US equities like it was over the last decade. So around the world, speaking of around the world, I think that the growth is so underappreciated right now of what we're seeing. In fact, in February, the IMF came out and revised GDP for the Eurozone, much more than expected, and just reiterated that number, 2.9% for 2023, and to end the year at 3.4%. I don't think anybody was talking about that, myself included, by the way. I thought this time last year, Europe probably already was in a recession. But their manufacturing has been stronger than expected. The consumer confidence has actually been better. Their job market is improving. Inflation is coming down from 9.2% to 6.4%. They got to get down more, for sure. And they're raising rates as well. They're going to slow, but they're starting at a higher point. And also, they're benefiting from China reopening, right? Big trade partners. And I'm going to toss in the warm weather. They got lucky. They had a warm winter. So I think we can talk about where you want to be investing, but I think the economy is actually a little bit better than expected. I think China also is just beginning to see improvements. And it's going to be choppy for sure, but they also had 3 years of pent-up demand. And the IMF raised their GDP growth rate to 5.2% this year. And they just reported the first quarter, and it was 4.5. And that might not sound like a lot, but that's versus 2.6 the prior quarter. So they're starting to see improvements, and they just went maskless last month, right? So they were still wearing masks a month ago. So they're reopening, and you're starting to see their manufacturing reports and their services numbers that are coming out that are in expansionary mode. In fact, their ISM services number was the highest in a decade at 58.2. Remember I said 50 is a diffusion, so anything above 50 is expansion, and anything below is regression. So they actually are seeing better results in their services, and their subway ridership of the 10 largest cities last month was up 112% year over year. Okay, they were closed last year, so to be fair, the numbers look good, but the point being is that they're reopening. And I track a lot of data out of Macau. It's a big gaming region in China, and the numbers are off the charts. Some of the companies that just reported that have exposure to Macau grew revenues 70, 80% year over year. So people want to get out and about. Japan, I think, is also interesting. The IMF also raised their GDP number to 2.3%. And I'm kind of torn about Japan. I haven't really had to pay attention to Japan because they've got a lot of issues, demographic issues, since like the 80s. But one thing caught my attention. Warren Buffett, you might know him or know of him, one of the smartest investors of all time, if not the smartest. He is actively buying companies in Japan, trading companies, which is sort of interesting. So where do I want to be? I still want to be here in the US, but the markets are expensive, so I have to be selective. Right? There are sectors and stocks that are trading below where the market is trading. The market's trading at about 18, 19 times. Historically, it's been about 15 times. But I like the transparency. I like the market share gains that US companies have, the pricing power, and their ability to hold on to margins, which everybody just doesn't give them the benefit of the doubt. And they've been wrong. China, I do want to have exposure to China, as I just mentioned, but I do not want to own a China pure play. I do not want to own a Chinese stock because there's zero transparency, and you can do all the fundamental analysis you want. You wake up one day, and the CEO is removed from the company, like Jack Ma from Alibaba. We don't even know where Jack Ma is to this day, right? I mean, it's just remarkable that that could happen to one of the largest Chinese companies. And so I want to have US companies that have exposure to China. There are plenty of them. Europe, it's cheap. It's trading at 11 times forward estimates. It's always cheap. And I always look at it and say, well, it's really cheap, and the margins are really depressed at a lot of these companies, but they're limited in terms of what they can do in terms of restructuring, because they have regulation, right? So again, I have plenty of US companies that have exposure to Europe, and I do want exposure to Europe, because I think both those countries are growing more than people give it credit. And Japan, yeah, I think, there are certainly names that really big blue chip names that are worth taking a look at. But again, it's the 3 Bs. They have better growth, they have better accommodation from their central banks, and they got Buffett. So just a couple of themes, really quick. I just want to check the time, okay. A couple of themes for really the medium to long term. Number one, it's not going to surprise you, consumer. Right? I still believe the consumer will hang in there, and I want to have exposure. As I mentioned earlier, we are a nation of spenders. We will take on debt. I want to lean more on services versus goods companies. But I do believe that even if we go into a recession, I don't think it's going to be a real hard recession if we do go there. And I think the consumer will come out fine. They're in much better shape. We have so much more momentum in the system than we did pre-COVID because we put so much money into the system, both fiscal and monetary policy-wise. Housing, I'm not a chartist, but I have a lot of friends that are, and some of the nicest looking charts are the ones that kind of go up to the right, and if you look at any housing stock, they are really pretty charts. But the fundamentals are really decent. They're getting better. I think we're troughing. And it's 15% of GDP, but there's a multiplier effect to housing, right? So you buy a house, you have to furnish the house. You probably buy stuff outside the house. And then you got to buy a car to get from the house to wherever you're going. So it is a multiplier effect, and housing is very highly correlated to auto sales. So I'm not a big fan of the auto industry, but the two are very highly correlated, and the auto North America SAR has been going higher every month consecutively for the last 6. We're almost near 17 million. So new home sales, while I said the numbers were really crummy, but new home sales as of last month were at a 1-year high. We have had 13 years of underproduction from the industry. We're 5 million homes short, and you have 5 million millennials that are looking to buy a home for the first time. So those are pretty darn good trends, right? The National Association of Home Builders, the numbers, they're polled monthly, and their numbers were the highest since 2022, a year ago. So sentiment is starting to pick up, and that has to do with interest rates. Actually, the 30-year fix has come down. It got as high as a 30-year fix was at 7%. It's now getting close to under 6, and if it goes lower, you'll have even more demand. And home prices have also come down, so the affordability is a little bit better. Not great, but a little better. So I like housing. Industrials. There's a lot of ways to play industrials, and it's about 12% of the US GDP, so it's important. And it too has a multiplier effect. For every one job that is created in the industrial manufacturing industry, 7.1 other jobs are created around it. So that's why you hear politicians talking about manufacturing and putting together all these bills, stimulus bills, and that sort of thing, because it really does work in terms of job creation. So Congress did pass $1 trillion worth of infrastructure bills, and we're now starting to hear from companies that backlogs and orders are getting built to deal with the supply chain fixes. I'm not a farmer, but I kind of think it's kind of cool that there's something called precision farming technology. And what does it do? It makes the farmers more profitable, more productive, smarter. You don't need as many people because you've got technology doing all of the heavy lifting, no pun intended. So it's very cool, and the companies that are involved, as a result, have raised their margin targets between now and the end of the decade. I mean, that's unheard of. Who knows what the heck is going to happen between now and the end of the decade? But it is pretty interesting that this technology has really transformed this industry. So then there's also just pure infrastructure, right? So we have 600,000 bridges in the country. 46,000 are structurally deficient. The average age of a bridge, 44 years old. We have 9,900 bridges that are over 100 years old. We have to do something about that. And I think that's a theme in a pretty big way. By the way, I'm from New Jersey, but I've been on the Brooklyn Bridge. And the Brooklyn Bridge is one of the oldest bridges. And it's 140 years old. It's really cool, though. You can walk it, you can run it, but I don't know if I really want to go on it until they do more fixing. Aerospace, it's a duopoly. I like the aerospace cycle very much. And global travel is back to 95% of pre-COVID levels. And it could grow to 9.5 trillion by the end of this year. So I like that. With a CAGR of 10%, I like the aerospace cycle, and a lot of industrial companies are suppliers and manufacturers for the big two. Energy, I do like energy. It struggled this year, and I think it's because of recessionary fears, and also because the last 2 years they've had record profits and they were amazing companies. But the oil companies have changed. The strategy has changed. They lost $76 billion in 2020. And they had ESG investors pressure them to change their ways. And so the companies actually listened. So instead of overproducing, They're actually taking the free cash flow and they're sending it back to shareholders in terms of buybacks and dividend increases, special dividends. These companies are all minting money, even $50, and about $50 is the break-even number. But they're minting money, and I love companies that have strong free cash flow. And they're doing the right things in terms of creating shareholder value. You also have a very limited permitting. You have the SPR that's down 37%. OPEC Plus is cutting. It's a pretty tight supply at this point, but it's not getting a lot of credit in the market, again, because of the macro, but I think the overall supply-demand characteristics are very favorable. And then technology, I would be remiss if I didn't talk about technology. I mean, it's everywhere, we know, but there's some cool numbers here. So AI, we all know about AI. It is about $186 billion total addressable market. It's headed to $1 trillion by the end of this decade. I think that is way low, just based on what we're hearing from Microsoft and Apple and Facebook, Meta, Google, Alphabet, that kind of thing. I mean, the technology is amazing. And it's only going to get more amazing the more you input into the system, right? So that's going to be 1 to 2 trillion is what they say by the end of the decade. I think that's more. Cloud, it's a $500 billion total addressable market. It will too also be $1 trillion total addressable market by the end of the decade. Cybersecurity, I'm a big fan of cybersecurity. And I think these numbers are so low. 174 billion total addressable market today, getting to 424 billion by the end of the decade. I think that's $1 trillion easily. And data center is going to be about a $500 billion total addressable market. So these are 4 themes that I think you want to have some sort of exposure to. You can play it on the pure plays. There are plenty of companies out there that have exposure. You know who they are, likely. You could also play it through the semiconductor cycle, because the semiconductors, that's their clients, right? So semiconductors were the first to kind of lead us down last year about this time. And because you saw double and triple ordering due to the supply constraints, they were just trying to order as much as they could get. And then they did, and then they got stuff, and then the demand fell. So boom, bust. But I think you're starting to see a trough in the semiconductor cycle. And they too have exposure. AI, cloud, Internet of Things, auto. By the way, there are 3,000 chips that go into an auto, that go into a car. That's pretty powerful. So I think that's certainly interesting. And then last but not least, I'm just kind of like talking my own book here. Animal health. I have 3 cats and a dog. And I think that this is really an interesting theme, because there are 46.3 million households that have a dog. And they are the most popular to go and show up on a vet's table. And the market's big. It's $57 billion, going to grow at a compound annual growth rate of about 5.5% per year until the end of the decade. Steady Eddie, it's not as glamorous as AI, but I think it's certainly an underappreciated theme. And that's all I have. Are there any questions? I don't know if we have time. We do? Okay. Okay. If anyone has questions, yeah?
I have a question about onshoring. I'm in the manufacturing sector, and everywhere I go, I hear the same thing. We want to get out of China. Would you talk about what you think that long-term trend is?
I think it's one of the best themes and the longest themes. It takes a long time to build a manufacturing plant. You probably know it. It's like 4 years to build a semiconductor plant, right? So we're hearing all different kinds of companies leaving China, but not just coming here. They're actually going all over the world. A lot of them are going to Latin America now. Apple's made a really big push there, but it will take years to divest from China because, quite frankly, I mean, it really helped the bottom line at these companies. So everybody did go to China because it was so cheap to do things there. So I do think that it is something that is just beginning. You're in the first or second inning of it. And that's why I cited some of those companies and the growth rates. I mean, industrials don't typically grow 15, 20% in total revenues, right? But they're seeing a lot. In fact, the CEO of Union Pacific said that they were like running full tilt in cement in terms of shipping it, and he cited onshoring. And you could say the same thing about steel, and you could say the same thing about lumber. They talked about that too, but they definitely see a very strong tailwind for sure. Oh, hi.
It used to be that people said there was a recession when you had 2 negative quarters, or there was a yield inversion curve, or this or that. The goalposts keep moving as far as what the definition of a recession is. What is Stephanie Link's definition of what we are in a recession?
2 negative GDP quarters in a row, technically. But honestly, I think it's what you just said. It could be a lot of different things. We're gonna slow. We shouldn't be afraid of it. Everybody is talking about it. It's the worst kept secret, right? Every day we talk about recession. Yield curve inversion is important though, because that's been the better predictor, but it usually lags. As soon as you invert, it's like 12 to 18 months thereafter where you see a recession. We're probably right around there because we started inverting last year. But there's all kinds of funky stuff going on in the bond market with us changing from QE to QT. And so I think I'm not saying it's not indicating that we're going to slow down. It is. We're going to definitely slow down. I just don't know if it's as accurate this go round. I don't want to say it's different this time. That's a bad thing to say because that's not good. But I do think that if we have 2 negative quarters in GDP, we are technically in one. By the way, when you do see that we're in a recession, that usually is the bottom in the equity market. Well, thank you very much. It was great to be here.